Denmark's tax structure is often cited as a model of balance between competitiveness and social welfare, and understanding how it influences foreign-owned companies is critical for any executive considering investment or expansion in the Danish market. In this video, we will walk through the key elements of the Danish tax system that matter most to foreign investors, examine how they shape operating decisions, and highlight the practical implications for long-term strategic positioning. From the outset, it is important to recognize that Denmark combines a relatively moderate corporate tax rate with a high personal tax burden and a very transparent, predictable regulatory environment. The statutory corporate income tax rate is set at a level that is competitive within the European Union, but the real story lies in how the broader tax ecosystem affects everything from capital allocation and financing to talent attraction, supply chain design, and holding company structures. For foreign-owned companies, the headline corporate rate is only one dimension of the decision calculus. Denmark offers a clear and stable framework for the taxation of business profits, including rules on transfer pricing, thin capitalization, and controlled foreign companies. These are designed to protect the Danish tax base without creating undue uncertainty for compliant multinationals. In practice, this means that foreign-owned entities operating in Denmark can generally anticipate a high degree of predictability in tax outcomes, provided that their structures and intercompany arrangements reflect genuine economic substance and arm's-length pricing. At the same time, Denmark's approach to withholding taxes on dividends, interest, and royalties plays a central role in how foreign groups structure their capital flows. Double tax treaties and EU directives often reduce or eliminate withholding on payments to qualifying parent companies in other jurisdictions, which can mitigate the risk of economic double taxation. However, anti-avoidance measures, including beneficial ownership tests and anti-treaty shopping rules, require foreign-owned companies to ensure that intermediate holding structures are not merely formal shells. This has pushed many groups to simplify structures and base more real activity, governance, and decision-making in Denmark when they choose it as a hub. Personal taxation is another defining characteristic that influences foreign-owned companies indirectly but powerfully. Denmark has relatively high marginal tax rates on labor income, combined with significant social security contributions embedded in the broader fiscal system. From a corporate perspective, this raises questions about the cost of senior leadership, specialist roles, and internationally mobile talent. Yet, the high tax burden is offset, in part, by the quality of public services, including education, healthcare, and infrastructure, which can be a strong pull factor for employees relocating with their families. For foreign-owned companies, the talent equation is not simply about gross compensation. It becomes a discussion about total value proposition, retention, and employer branding in a country that consistently ranks highly on quality of life indices. Another important dimension is Denmark's treatment of research and development and innovation-driven activities. While Denmark does not always rely on aggressive headline incentives, it offers targeted regimes, such as favorable treatment of R&D deductions, refund mechanisms for companies in a loss-making R&D phase, and in some cases beneficial treatment of intellectual property income under specific conditions. This can encourage foreign-owned companies to place high-value, innovation-intensive functions in Denmark rather than limiting their presence to sales or back-office operations. The net effect is that the tax system nudges multinationals toward deeper integration into the Danish economy, rather than purely transactional or tax-driven footprints. Transfer pricing is particularly relevant for foreign-owned entities that operate cross-border value chains. Denmark adheres closely to OECD guidelines and maintains robust documentation and reporting requirements, including country-by-country reporting for larger groups. While this implies a certain level of administrative work, it also gives foreign-owned companies a clear framework within which to design and defend their pricing models. Compared to jurisdictions with more discretionary or less transparent enforcement, Denmark's approach reduces the risk of unexpected large adjustments, provided that companies maintain documentation, conduct benchmarking analyses, and update models as business conditions evolve. Another feature influencing foreign-owned companies is Denmark's stance on debt financing and interest deductibility. Rules that limit the deductibility of net interest expenses, along with thin capitalization and earnings stripping provisions, shape how multinationals choose to finance their Danish subsidiaries. Highly leveraged structures that might be viable in more lenient jurisdictions are less attractive in Denmark, pushing foreign groups toward more balanced equity debt mixes. While this may marginally increase the cost of capital for some, it also supports financial stability and can be viewed positively by stakeholders who value prudent balance sheets and reduced exposure to base erosion risk. Indirect taxes, particularly value-added tax, also play a day-to-day role. Denmark applies a standard VAT rate that is in line with or slightly above many European peers, with relatively few reduced rates or exemptions. For foreign-owned companies, the key implication is operational. VAT compliance processes must be robust, and pricing strategies need to account for the impact of VAT on end consumers, especially in sectors where margins are tight. On the positive side, the simplicity of the VAT structure, with limited special rates, can reduce complexity relative to markets with more fragmented systems. Beyond individual tax instruments, the broader institutional environment is a major influence on foreign-owned companies. Denmark consistently ranks highly for transparency, low corruption, and regulatory reliability. Tax authorities usually maintain a professional, rules-based approach, and options such as advance rulings or dialogues on complex transactions can help foreign investors obtain clarity before committing significant capital. This predictability can be a decisive factor for boards weighing Denmark against markets that might offer lower nominal tax rates, but come with higher political, legal, or enforcement risk. At a strategic level, the combined effect of Denmark's tax system is to favor international groups that prioritize sustainable, long-term operations anchored in real economic activity. Companies that rely heavily on aggressive tax planning or shifting profits to low-tax jurisdictions will find Denmark less accommodating due to its comprehensive anti-avoidance framework and active participation in international initiatives such as the OECD's base erosion and profit-shifting agenda, and discussions around global minimum taxation. Conversely, companies that build genuine capabilities, invest in human capital, and integrate into local value chains can leverage Denmark's system as a stable platform for Nordic or broader European operations. In practical terms, executives considering Denmark should focus on 5 priorities. First, assess the full effective tax rate, not just the statutory corporate rate, incorporating withholding taxes, interest limitations, and local incentives. Second, ensure that group structures and transfer pricing policies can be clearly substantiated under OECD-aligned rules. Third, develop a compelling employee value proposition that accounts for higher personal taxation, but leverages Denmark's social infrastructure and quality of life. Fourth, evaluate the potential to locate R&D, innovation, or regional management functions in Denmark to maximize the benefits of its stable environment. And fifth, build proactive relationships with local advisors and, where appropriate, the tax authorities to address complex issues early. In conclusion, Denmark's tax structure does not compete on being the lowest cost jurisdiction. Instead, it positions the country as a high-certainty, high-trust environment where foreign-owned companies can operate with confidence, provided they are prepared to align with transparent, substance-based rules. For organizations that value long-term predictability, access to skilled talent, and a strong institutional framework, Denmark's tax system is not merely a cost factor, but a strategic enabler. As you evaluate your global footprint, the Danish model is worth considering not only in terms of what you pay, but in terms of the stability and credibility it brings to your operations, your stakeholders, and your long-term growth agenda.